As of Saturday, August 1, 2026, the equity markets are officially closed for the weekend, with NVIDIA stock having closed its most recent regular trading session on Friday, July 31, 2026, at precisely $200.75 per share, representing an intraday surge of $5.71, or 2.93%, on massive trading volume exceeding 139 million shares, before settling in extended after-hours trading around $198.98. The broader institutional sentiment suggests that Wall Street remains utterly fixated on hyperscaler capital expenditure budgets, yet a glaring structural risk is forming beneath the surface that most casual investors are completely ignoring. Every major desk across Wall Street is operating under the baseline assumption that data center infrastructure demand will scale infinitely in a straight linear trajectory. However, the true inflection point facing semiconductor valuation right now is not whether big tech continues to spend, but rather the silent commoditization of AI inference hardware combined with escalating power grid bottlenecks across major metropolitan centers. While retail traders are obsessively monitoring quarterly top-line expansion, institutional allocators are quietly tracking electrical substation capacity, localized power purchase agreements, and alternative silicon architectures designed specifically to undercut unit compute costs. The prevailing market narrative around NVIDIA stock rests on an unshakable belief in total technological dominance. Ask the average retail trader utilizing a Robinhood stock trading app or managing portfolios on interactive brokers, and they will tell you that owning NVIDIA stock is essentially an index bet on the future of global computing. Wall Street research notes routinely project endless upside, pointing to record gross margins and deep software ecosystem lock-in through CUDA as an insurmountable moat. But when you step back and evaluate the underlying mechanics through the cold lens of self-investing and individual brokerage data, that consensus begins to look surprisingly fragile. The market treats every semiconductor rally as a validation of perpetual monopoly pricing power. Reality, however, shows that enterprise customers are aggressively deploying multi-chip strategies and capital-efficient custom silicon to prevent long-term vendor lock-in. The common expectation is that hardware demand remains infinite. Reality is that software optimization and custom ASIC deployments are actively shifting the economic balance of power back toward the hyperscalers themselves. If you look closely at recent stock movement over the past few weeks, NVIDIA stock has experienced elevated volatility, swinging between a 52-week low of $164.07 and a 52-week high of $236.54, reflecting intense tug-of-war dynamics between algorithmic momentum funds and value-oriented institutional profit-takers. During the last trading session, aggressive buying swept through options exchanges, driving turnover past $27 billion as call option volume spiked in anticipation of upcoming enterprise earnings cycles. Sector momentum across the broader semiconductor index has shown tight correlation with macro liquidity conditions, treasury yield movements, and corporate capital investment disclosures. When tech giants announce expanded capital expenditures, NVIDIA stock immediately catches a massive bid. Yet whenever energy sector reports highlight delays in utility grid connections or transformer shortages, semiconductor shares experience sharp intraday sell-offs. Large block trades appearing on institutional platforms like Interactive Brokers stock trading suggest that smart money is actively rebalancing, taking profits near local highs, while selling covered calls to capitalize on elevated implied volatility. To understand why this momentum behaves so erratically, one must look closely at what the company actually builds and how its business model operates. Beyond the financial headlines, NVIDIA stock represents a core holding across millions of accounts on SoFi Invest, Schwab Intelligent Portfolios, and Fidelity brokerage accounts. The firm functions as a vertically integrated accelerated computing provider. While widely recognized as a designer of high-performance graphics processing units, its true economic engine is the seamless integration of proprietary hardware, advanced networking fabrics, and specialized software libraries. NVIDIA designs high-performance computing chips that are manufactured by external foundry partners, relying on cutting-edge advanced packaging techniques to fuse memory modules and processing cores into massive compute clusters. The proprietary CUDA software platform acts as the operational foundation, allowing developers to write software that executes directly on parallel architecture. Historical performance metrics show unprecedented top-line growth over the past 3 fiscal years, with quarterly revenues exploding from modest baseline levels to tens of billions per quarter. However, past performance reflects a gold rush phase where supply was heavily constrained and pricing power was absolute. As we look toward the future outlook, the key catalysts and structural headwinds will determine whether NVIDIA stock can sustain its current multi-trillion-dollar valuation tier or face a cyclical mean reversion. The upside scenario relies on the rapid acceleration of physical artificial intelligence, autonomous systems, robotics, and industrial digital twin simulations, where compute requirements scale exponentially beyond standard natural language processing tasks. If enterprise adoption expands seamlessly into these industrial applications, demand for high-density compute architecture will outpace market supply for several years. Conversely, the downside scenario hinges on custom chip adoption by major cloud providers, regulatory export restrictions on international shipments, and severe power grid constraints that physically cap how many high-density data centers can be energized simultaneously. If cloud titans successfully migrate a significant percentage of their daily inference workloads onto internal silicon, NVIDIA stock could experience margin compression even if top-line revenue volumes remain elevated. Investor expectations are calibrated for flawless execution and uninterrupted gross margin expansion. Reality suggests that market forces, corporate buyer leverage, and supply chain realities will inevitably introduce structural friction. Comment below how many shares of NVIDIA stock you currently hold in your individual brokerage account and whether you plan to buy or sell before the next earnings release. To cleanly summarize our analysis, NVIDIA stock closed its most recent trading session at $200.75 per share, driven by strong short-term trading momentum and elevated options volume. Yet the contrast between investor expectations and market reality could not be starker. While the crowd sees an uninterrupted runway of endless capital spending and market exclusivity, sophisticated investors navigating online investment platforms must weigh that optimism against emerging energy grid limits, custom silicon adoption, and valuation multiples that leave zero margin for operational error. Whether you execute trades via SoFi Active Investing, maintain long-term positions on Robinhood investments, or manage sophisticated asset allocations through Fidelity Wealth Management, understanding the subtle shift from hardware scarcity to software efficiency remains the critical edge in evaluating this chip giant moving forward.